Morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, February 14th. I apologize for a little bit of a delay in the release of the podcast. It was for fairly obvious reasons. Last night was the Super Bowl, and I had a number of friends who came out, and we had a super back bowl weekend. So skiing all weekend and then enjoying the football game, which was a pretty good one, even though I had no dog in the fight this year. No Patriots. So anyway, the report this week was titled, "The Fed is a fast follower." Excuse me. The Fed is a slow follower. It was a play on the term being a fast follower. And we'll get into exactly where we were going with all that. But there were three real sections of the note. The first one was titled the CPI 2x4. The second one was all about the Fed's mop and mopping up all the excessive liquidity and what the implications are for both markets and the real economy. And then the final section was 60-40 foiled again, meaning the stock bond correlation or stock bond 60-40 model didn't have a particularly good day on CPI day. So the first section, the actual title to that section was Rut Roh Rorge, a little bit of a play on the Jetsons, but it was all about this CPI shock number on Thursday and the subsequent market reaction to that. There were a number of things that we thought were really interesting on that day and said a lot about the go forward outcome. One was we had a 21 basis point jump in 2-year yields on Thursday, which on the surface you would attribute to the Fed being far more hawkish. But when indeed you looked at the composition of that change, there was a 22 basis point increase in inflation, the inflation break-even rate over 2 years. And the real rate, which is the rate really determined by the Fed, actually fell by a basis point. So that hinted that the Fed was not going to be such a fast follower. They were in fact going to be a slow follower. And that even was true after St. Louis Fed President Bullard's comments to the Wall Street Journal, which triggered such a sharp equity market reaction. However, back out or in the back end of the market, tens moved obviously not as much as twos, but there the move was dominated by real rates, and the move index really moved. And so we had a pretty good spike in rates fall. That combination hinted that perhaps the Fed was going to be more aggressive with their balance sheet management as a consequence of this moving inflation than we thought. And we'll come back to that, but it really is a key issue when you think about Fed signaling effect, forward guidance, how they like to manage markets, and how they could do that efficiently. Do they want to start with a shock 50? Or would they prefer to start with a 25, but get that balance sheet contraction started right away? So this is going to be an ongoing issue. Many of you may have seen that Twitter was a little bit of a buzz with a announcement on the Fed website that they were having a meeting on the 14th. They do this as a standard order of practice, but there's quite a bit for them to discuss today. So if you then move on to the CPI report and start thinking about what's actually going on there, the report was obviously very disturbing. Goods prices were up 1% on the month. That puts the year on year at 11.7. Participants are looking for the market for that part of inflation to cool off, and there's no evidence that that's yet occurred. Services inflation, though, is far more concerning for the Fed and for us. On a year-on-year basis, core services inflation jumped from 4% to 4.6%. And one of the areas we've been describing as transitory disinflation, i.e. medical care, was up 0.7 on the month. It's been moving over the last 4. And so the quarter on quarter, 4 months, that is, the quarter on quarter annualized rate for medical care inflation jumped from 2.4% to 3.8%. So it looks to us like that transitory disinflation from people foregoing elective surgeries and care is starting to dissipate. And you'd expect that to really be a big contributor to inflation on a go-forward basis. Education still hasn't moved. It's still sitting at 1.6%. That'll revert to long-term trend, no doubt, as well. And that's well over 3.5%. So then when you start thinking about why the markets, equity market in particular, initially reacted somewhat calmly to the inflation print, at least prior to Bullard's comments to the Wall Street Journal. We would describe the number as a little bit of shock and awe, actually more like shock and awe. And so the shock piece is we tend to look at the standard deviation of inflation, right? The rolling 1-year rate as a measure of inflation volatility. Believe it or not, that's actually falling a little bit. And it makes sense, right? Inflation was less than 2% a year ago. Now it's at 7.5%. But that first portion of the move, when it really started to accelerate, caused that standard deviation to really jump. And now that we're up at these levels, it's starting to ease back a little bit. If you combine that with inflation surprise, that's just how the numbers are coming out relative to expectations. There's a Citi Inflation Surprise Index. That Citi Inflation Surprise Index peaked late last summer and is actually coming off. That standard deviation peaked in October is starting to come off. So we're getting a little more accustomed to this. And that speaks a lot to initial market reactions, but it shouldn't give you a lot of comfort. The O part is our correlation measure. So we look at 20 major components of CPI and then built a covariance correlation matrix around all this. And the number for the month of January was 0.33. That's up from 0.29. May not sound all that high, but when you consider in the 2010s, correlation was effectively zero. And that was our explanation for that was the shale oil shock that caused crude prices to fall so sharply. Technology innovation adoption and Chinese labor, all those things were exogenous factors that were causing the correlation of all those various components of CPI to effectively be zero. Well, that 0.33 reading is higher than the March 70 spike. There were 3 big spikes in the 70s. It's below the July 72 spike to 0.42% and the August 74 peak of 0.5%. But this, again, is the third highest reading in that measure's history going back to through the 70s. And that just underscores how inflation has really broadened out. And Bullard was on CNBC this morning, and that's what he was talking about, is just how broad-based this advance is. And then when you just think about it a little bit more qualitatively, reopening-related sectors, inflation was up. Supply chain related sectors, inflation was up. Housing, medical care, services, right? This is a broad-based, significant problem for the Federal Reserve. They're way behind the curve. This moves us on to our section about the Fed being a slow follower and how this signaling forward guidance dynamic is such that if they want to avoid a 50, and they may very well decide to do that, we still haven't seen the semi-annual monetary policy report, known generally as Humphrey Hawkins. We haven't seen that scheduled yet. Perhaps that's related to the Fed votes. We've asked a few people about it. No one seems to know, but it's supposed to happen in late February, late July. So the chairman obviously has to get the committee on board. You've got a big divergence of opinion. You've got the coastal doves who still want to do this passively. You've got the Midwestern hawks that think that we should be much more active around balance sheets. And Bullard's talking about getting 100 basis points of tightening done by July. You'd have to have a 50 in there if you're going to do that. We don't think a pre-March hike is on the table at all, but they could signal a 50 and Powell could do that at that testimony if that indeed does occur. He may decide to do it in a speech. Again, though, we think they could be far more effective if they just started balance sheet contraction in March alongside of 25. When you step back from all this, though, and move away from all the day-to-day concerns about the Fed and think about what the real macroeconomic effects are going to be, we walked through an exercise in our note this week about just how the liquidity environment sets up and how levered the private sector actually is to higher rates. And so here's a couple of factoids about all that. The RRP program has about $1.5 trillion or $1.6 trillion in it right now. That could go back to zero and it would have really no macroeconomic effect. Bank reserves are $4 trillion. When they got to 1.5 in September of 19, repo rates spiked. So that may be the lower end of where bank reserves should be, although the Fed has put this standing repo facility in place to try and cap another spike like what occurred in SEP of 19 when repo went to 19% for a day or so. That notwithstanding, you could draw down at least a couple of $1 trillion. So let's say you take $1.5 trillion out of the RRP program, you take $2 trillion out of bank reserves, that's 3.5. If the Fed were to drain or contract their balance sheet by $100 billion a month, which was the upper end of estimates, that's what we think they're likely to do. That's 3 years before they get to that liquidity level where you're sort of at an equilibrium level. All that liquidity is just sloshing around the system. It impairs bank profitability. There's some chart in the notes to show you how when that level came down in 2018 and 2019, bank ROE went above 10%. Right now, those reserves are actually a net negative for bank profitability because they're bumping them up against leverage requirements. Broader way of saying, we just think this liquidity is excessive and the Fed draining of it is not going to have any macroeconomic effect other than potentially helping the banks, making them more profitable and more inclined to make private sector loans. And then when you dig into the private sector sensitivity to higher rates, we've talked about how the corporate sector duration on the corporate index is 12 years. So there is some talk, some of this stuff has been swapped back to floating, but we don't think the corporate sector is particularly vulnerable. We have a chart in the note showing household or consumer debt service and how mortgage interest is almost half of what it was in the peak of 07 as a percent of disposable income. Those household sector measures, so-called financial obligations ratios, which is how much of household disposable income goes to interest payments, have never been lower since the Fed started measuring this in 1980. So jacking those rates up, we just think will be a non-event for the household sector. So when the Fed starts tightening, as much as we worry about the signaling effect and then potentially going 50, keep in mind, we think that the net macroeconomic effect will be nothing, if not even a net positive because of the effect on bank profitability. So what's an investor to do was the final section of the note. We talk a little bit about how rare it is to have, and this is courtesy of our friend and colleague over at Macro Risk Advisors, Dean Kernett, who talked about how we've only had 5 occurrences in the last decade or so where you had the TLT, which is the iShares long-term Treasury ETF, and S&P 500 both go down by 1.5% in a single day. That happened on Thursday. So that's the 60-40 model, right? 60% stocks, 40% bonds. Treasuries are your hedge against big decline in equities. That's how this model is starting to fall apart. And we think that's going to be a trend through the cycle where bond returns are generally negative, stock returns will be more positive, and we'll have a flipping of that correlation that's been so prevalent for the last couple of decades of disinflation and Fed activist monetary policy. So what do? We think a retest is possible. We had a number of those last cycle. The end of QE1, you had a sharp sell-off, then a 50% retracement, the end of QE2, the end of zero interest rate policy. So that's entirely possible. Were we to get down to 4,200 or so, we think that's a bit of a gift. You should definitely buy there. We'd be a buyer below 4,400. What would we buy? Well, it's the same stuff we've been telling you to buy, the reflationary sector. So energy, materials, industrials, and financials. We also like the healthcare sector and think there's going to be a bit of a reopening there. That's related to the pricing and medical care inflation issue we were talking about earlier in this video and podcast. So that's where we're at this week, and it should be an interesting one for sure. We'll be back in a week's time. But again, if we get further weakness, we'd be a buyer. Barry Knapp, Ironsides Macro. Please consider becoming a subscriber to our full research if you're not already. And have a good week, everyone.